All right, it looks like the rate of participants joining is starting to slow, so we'll go ahead and begin as final couple attendees trickle in the door. So good afternoon, everyone. I am Brad Long, Chief Investment Officer, joined here by Chris Maxey, Chief Market Strategist. Thank you for taking an hour out of your summer here in July to join us. We're going to run through, a lot. We're going to run through where we sit with markets. We know I got a little bit of market volatility coming through the board today, so we'll put that into context. But we're also going to take a little bit of a detour here. We're going to sprinkle in some really fun America 250, right? America just turned 250 earlier this month. We're going to run through some of the foundational and fundamental things that have been driving US American exceptionalism and how that applies to us as we invest in markets, how that applies today, and how we think about current portfolio positioning and what it really means for us going forward in the future. As always, if you have questions, you can put them in the chat queue. We'll try to get to them throughout over, say, the next 45 minutes or so. If we can't get to them, don't worry. We'll follow up with you, or you're always happy to follow up with your advisor, and we'll make sure to address them there. So with that, we got a lot to cover and a lot of fun to have. So Chris, I'll turn it over to you, and we can begin on America 250.
Great. Thanks, Brad. I don't think it's often we get to say that we're going to have a lot of fun throughout the course of a macro and market conversation, but let's see if we can at least liven it up a little bit and make it enjoyable, as I'm sure people are tuning in from the beach, as they likely we're just so enthusiastic about joining us today. So, as Brad mentioned, we're going to walk through what's happening in the stock market, the bond market. We'll give you an outlook. Interspersed throughout, though, we really wanted to talk about the fact that America did hit that 250th anniversary. And as Brad mentioned, happy birthday, America. It's been quite an exciting summer as we look around. We see that the World Cup was happening all over the country. There were a lot of celebrations. Hopefully, everybody was able to enjoy a get together or two with family and friends and really celebrate the fact that these type of milestones don't come along all that often. Now, what we want to talk about throughout the course of the conversation, though, is America was founded 250 years ago, and there have been so many unique things that have brought us to where we are today. As much as we would like to go back to day one and walk through that history over the course of those 200 or 2.5 centuries, we're not quite going to have enough time to do that. But it's always interesting to reflect back on history and think about where we have come from and how that's brought us to where we are today. There's so many parallels between current markets and current economies and what we've seen over these last several hundred years. So we're going to try to draw on a few of those historical parallels, not too many of them, because we don't want this to feel like a college course and run the risk of putting everybody to sleep. But we'll at least draw a few of those parallels to what's going on as we think about artificial intelligence and the build out in AI, and a lot of the headlines that many of you have probably read about in just these last 24 hours. We see that some of the biggest companies in the United States are reporting earnings, and all of a sudden, free cash flow is negative, and we've seen some pressure on earnings because of the build out and the expenses associated with AI. So let's get into it and talk about what's going on, how we can draw in past history to where we are today. Now, thinking about the evolution of cycles as they happen over time, there's many similarities as you look at past evolutions relative to the 1800s, the 1900s, and even where we are in the current era and the current day. So as we go through the full conversation today, keep this evolutionary arc in mind, or at least in the back of your mind. What we have seen going back to the railroad environment, as we pointed out, or the build out of the railroad system in the United States in the 1860s, going into the internet in the late 1990s, and even with AI today, is that you have this general tendency of there being a technological breakthrough. That technological breakthrough feeds into infrastructure build out. But more often than not, what takes place after that infrastructure is built out? Well, there's a lot of speculation, there's a lot of excitement, there's a lot of capital that flows into the opportunities that are of excitement in that day and age. AI and artificial intelligence is no different today than all of the cycles that we have been through in the past. The one primary difference is the magnitude and the size of the dollars. We're currently talking about spending on the order of hundreds of billions of dollars. And, as we can all imagine, those type of numbers have really not been relevant or present in the past. But as you move past that speculative bubble, what comes next? And it's the question that we often get the most from clients is step four, which is the idea of a bust. As Brad and I were talking about this, the idea of a bust is not something that we should all necessarily be fearful of, but it is most definitely something that we need to prepare for in the course of building our portfolios, building our allocations, thinking about how we're guiding towards our financial plans. Because the bust can impact our goals, they can impact our psychology, they can create a lot of negative behaviors that people wind up making in the course of investing their portfolios. Now, the reason we say the busts are not necessarily a bad thing, and that's been particularly true in the US, is because it leads to future productivity, it leads to future growth of infrastructure, and it is something that has been really relevant and present in the American psyche for hundreds of years. What I mean by that is we've often gone through the bust and then emerged on the other side with new technologies, new opportunities for productivity growth. And then all of a sudden, the cycle starts all over again. We move right back to step one, and then we see that cycle start all over again. So, when has that been relevant? Not only today, but what are the other cycles that we've seen throughout American history? We can go all the way back to the 1780s if people really want to. I'm going to focus in on two areas in particular, and that's going to be in the mid 1800s. Um, Hopefully, or I imagine not many of us were alive at that time, but to give us a slight history lesson, in the 1830s, we didn't have a lot of opportunity to move about the country in anything other than horse and carriage. And so people would ride horses all over the country, and that's how goods were distributed from state to state or from one city to the next. The build out of steam engines and railroad, and then the canal system throughout the upper Northeast, in particular areas like New York State, really brought about a dramatic change, and that contributed to so much of what happened over the next several decades. But as you can see, in 1830, we had 23 miles of railroad that existed in the United States. And over the course of the next 30 years, there were about 30,000 miles of railroad that had been built. Why that was important is because it plays exactly into that arc we were talking about on the prior slide, which is that there was a new technological breakthrough that led to investment. That investment ultimately led to a tremendous amount of speculation. And on the other side of that speculation were bankruptcies, corporate failures, banks that were going out of business, and a lot of question around what's going to happen next. Well, the what happened next is that the country started to realize, well, it's gotten a lot easier now to move goods and services and people and labor to other parts of the country, and we continued to build that infrastructure to the point where it led to the electricity and steel and oil industries, and then we started moving into mass production through factories. But you can see that even in just these last 70 years, you've had the aerospace and nuclear industry, you've had digital and personal computing that came online, and it feels like the technological evolutions are happening faster and faster and faster. So that brings us to present day and what's going on as we think about AI and automation. Well, down at the bottom, there's a number that I think jumps off the page to many of us, which is that hyperscaler CapEx, that means spending by the companies that are growing the fastest in today's current economic environment, which is Google and Meta and Amazon, right down the list of those top 10 companies, is estimated at more than $800 billion in this calendar year alone. Not only that, by the time we flip the calendar to 2027, the number is estimated to rise above $1 trillion. That's not small numbers that we're talking about. And as everybody thinks of the current economic environment, why does the economy keep doing so well? Why do we continue to experience that strength despite all of the questions that are out there that have been on many of our minds? Well, it really just boils down to that single number. So, Brad, I'll hand it over to you to talk about what we see happening in the equity markets, and then bring us up to present day and speed with that starting point.
Yeah, I think we can go ahead and assume that no one was alive in the 1800s as opposed to hoping no one was alive. I did fall asleep this weekend to Back to the Future, so maybe there was a little bit of that in there, Chris.
Age is
All
catching up,
right,
huh?
so let's jump into where we sit today in across markets. So bars here are year to date. The circles are quarter to date. Dark blue here on the left is fixed income. Gray in the middle is equities globally, and then light blue on the right is real assets. Main takeaway here is there's a lot of proverbial green on the screen, whether it's quarter to date or year to date. Markets have been resilient and robust, even though we've thrown quite a bit at them. You can see a lot of the quarter to date is kind of stacked right on top of the bar chart here or near the top of the bar chart. It's because the pattern has largely been January and February. We were off into the races. February 28th, Israel and the United States invaded Iran. Markets took a big walk in December. Q2 largely caught up from what March fell behind. So, by and large, a lot of green on the screen here. A couple of things to call out. One is kind of the towering bars here in the middle. We see emerging markets and small caps. We'll get into AI in just a moment, but a lot of that is coming from AI and AI spend. We'll spend a little bit more time in a few moments talking about compute, power, demand, and chips. That is really what's driving that emerging markets column there, towering at about 24%. So if you've seen the likes of South Korea or other parts of Asia, companies like Taiwan Semi, companies like Samsung that are in and a part of the AI infrastructure and chip and compute build, they've been off into the races, and that's really been driving those markets. Small caps in a similar way, but more of the flywheel effect as opposed to directly AI companies, right? Mag 7 has largely lagged year to date, but small caps have been benefiting a lot from those numbers that Chris was mentioning on AI spend. We're talking about billions and billions of dollars that is impacting the real economy. It is impacting the earnings and profits of businesses, and it's not all accumulating in chips or in technology or in LLM producers. And so we see the broadening of that impact across the board. The one notable quarter to date negative here is commodities, as you can expect, and we'll talk about the unwind of this in Q2. We had a memorandum of understanding between the United States and Israel. I think many of us, and we talked about this last quarter, recognize that, call it the bookends of those two pieces of paper, were pretty far apart. There was a intention to find peace, to move towards resolution, but we were still talking about uranium enrichment. We were still talking about demilitarization of the United States presence in the Middle East. We were talking about really ownership and freight through the Straits of Hormuz. Those are big ticket issues, and they were pretty far apart. Now we're in a series of escalating, at the very least, rhetoric and in many ways conflict. And we'll talk about what that means in just a moment. So here we sit. Strong start to the year, big bump in March, really strong quarter, and you get this sense of oscillation, right? It's on, it's off, it's on, it's off. But we come back to a lot of the things that Chris mentioned over the long term. What really powers markets? What has powered American innovation and growth? And it gets to profits. So we're going to take a big step back for a moment and talk about what is driving markets today, and candidly, how markets still sit here year to date through July 23rd, even though markets are down a little bit today. And we're pretty near all-time highs. Yet we have this environment where we have geopolitical risk seemingly rising, and it's been coming from earnings, which we'll get into in a moment. But if we set the stage for that, this is that American engine, as Chris was talking about, innovation, whether it's steam and rail or automotive or canals. The American economy has been an incredible long-term producer of corporate profits for investors. If you take this from the 1940s up through today, this is annualized at over 7% in corporate profit growth. And by the way, In the 1940s, if you were to scour the index, you would not find a technology sector. You would not find a semiconductor sector. You would not find a lot of the things that we see in markets and driving markets today. And it gets back to that cycle of innovation, that cycle of growth, and that cycle of opportunity that has created incredible wealth that for those that have had the ability to have the foresight of A, where the puck is going, and B, have the patience to let that puck ultimately come to them in investing. And so it is a critical and important thing that we all as investors need to recognize on the long-term economic cycle. All right, so let's step off the America 250 pedestal and get into today. Right. So today markets have been cycling through periods of time since the 1990s of things that are hot and things that are not, right? So if we go back to I guess the light yellow or straw yellow line here, Chris, you and I really need to do a better job of both being colorblind of like pre-identifying what the colors are. We've got tech and hardware in the late 1990s, early 2000s. It was over 25% of the index, and you can see it precipitously fell off. Here we've got energy peaking at 16%. If you remember, that was the peak energy sayers. That was the peak oil conversation. It was, we'll never find more oil, but the world demands more of it. So price will go parabolic. Well, guess what? Enter innovation, enter technology, enter fracking and making the United States the world's single largest oil producer through the utilization of technology and fracking, which has changed not just the market, but that entire economic environment for access to light and sweet crude out of the United States. And so we go through these cycles of innovation and candidly failure or reinvention. And we're in a new innovative cycle today. The transition in cycle 2026 has largely been you go from software, which historically had been companies that had a large economic moat around their business. They produced the things that power the computers that allow us to do the things that many of us do on a day-to-day basis. That lived behind specialization. It lived behind people who, spent decades learning how to code. Here we sit today that in theory, not in practice per se, but, Chris could vibe code his own version of Outlook and create his own system. In theory, that's possible. In practice, it's probably a little bit overdone. But what it does mean is that pricing, pressure or the shrinking mode of software was really being expressed in the first half of the year. Now, for those that are falling, what is rising? Semiconductors has been an important part of the AI ecosystem, right? If you think about the end of the rainbow, which is you type into your favorite LLM, the question of the day, or maybe you use it in your normal workflow, that takes compute. That compute takes chips. Chips take power, right? And then we'll get to the commodities part of that, which obviously geopolitical risk is rising. And so semiconductors have been powering a lot of the S&P's move here forward, but have been on their own part of this next growth cycle. Now, as we sit here today and think about all the ebbs and flows of what's going to happen to software and is semiconductors, on just a new plane, or how do I think about AI and spend, and what about all the geopolitical risks? Well, the thing that has been powering markets without a question and really ignoring the rest has been earnings. It has been AI and AI investment, and it has been incredible earnings growth that we've seen here in the United States. Now, we're just starting Q2 earnings. Last week we had banks report. This week we've got a couple of big announcements. Alphabet was this week as well. But let's put a little bit of context behind this. Dark blue bars here are realized earnings growth. Light blue bars are expectations. Now, we closed Q1 with 28% earnings growth. That's a pretty extraordinary number. And that is 6 consecutive quarters of double-digit growth. But obviously Q1 wasn't just double-digit. It wasn't 10 plus, it was 20 plus. Now, expectations here for Q2, which we've just begun and we're starting to cycle through and see where that's landing, are for 23%. If we were to close Q2 achieving a 23% earnings growth or just above 20%, that would be the first time that the S&P has achieved back-to-back 20% earnings growth quarters outside of the bottom of a market cycle. There's three other times that happened back-to-back 2 quarters in a row. It was 2000 coming out of the tech wreck. It was Q1, Q2 of 2009, right after the GFC. And it was COVID, where we manufactured a global recession from shelter in place. And then you had a material rebid in business and activity. If we were to achieve that, that would be a fairly extraordinarily back-to-back earnings growth in the middle of an economic cycle. Now, Chris would be the first one to point out to say, well, maybe just expectations are too high. And that's a really reasonable stance to make, right? He calls it priced for performance. I usually call it price for perfection. So there could be some intermittent volatility here if markets begin to see earnings expectations not being met and meeting these lofty goals. But to again take a slight step back, not 250 years step back, but if we just say if we grew at 10% or more for Q2, that's our seventh consecutive quarter of double-digit earnings growth. And that is pretty darn good. So that is setting and really driving forward a lot of the opportunity here. Now, the good news about earnings growth is this is not just semis earnings growth, and it's not just tech earnings growth. It's wider than that. And if you think about, again, that rainbow, right? You're utilizing LLMs. Well, LLMs need compute, and compute needs power, right? How do how do data centers work? They need power. Well, the amount of power that is going to be or projected to be needed to power the increasing demand coming from AI is extraordinary. So the y-axis here is gigawatts. If you don't speak gigawatts, let me give you a little bit of context. 1 gigawatt is about the annual power production from a nuclear power plant. That's a lot of power. So if AI is to scale in the manner in which it's currently anticipating, the amount of power that is going to be needed to power data centers, to power cloud compute, to power all the chips and semiconductors that we've been talking about is going to be quite extraordinary. And so that's feeding through into the real economy and it's broadening into various sectors. On the next slide here, we'll show you earnings growth and expectations across a number of sectors. And you can see, the pretty extraordinary level here on earnings year over year expectations for energy up over 120%. That's a big number. And obviously there's a little bit of noise there. There's some basis effect there. But I would even call out a sector like utilities. Utilities are fairly regulated. If you rewind the clock over any reasonable period of time, people don't look at utilities and say, man, that's a fast growing sector. Today, earnings expectations for growth are 14% for utilities. It's because they're part of the power grid. Part of the power grid is driving AI, and that is where a lot of investment is going. So you can see the skew on the left here. It's industrials, utilities, materials, and then obviously tech, obviously benefiting in a material way, and energy is parting to supply, this overall infrastructure. So the market has clearly been focused, and candidly, maybe a little blasé around geopolitical risk, but it's been focused on earnings and earnings growth, and that's been powering year-to-date gains. Now, there's always a flip side of every coin, right? As we think of investors, we have to think of the balanced conversation. Earnings growth has been great. 6 quarters of double digit. We could be in a back-to-back quarter of 20% or more. But as Chris says, markets are priced for performance. Here we sit today, price to cash flow, an equivalent version of price to earnings at greater than 15 times. Average 5-year return, call it flat, up 1%. Now, I will say, the bottom right box here, that max number, 15%, that number used to be a lot lower until the most recent 5 years, where we've been sitting at a more than 15% price to cash flow. And we've achieved that 15% number. If you were to rewind the clock and not include this period, that number was negative. So here we sit today where markets are priced and ready to roll for all of these great things that we're talking about. But it's not just all good news. We'll talk about geopolitical risks in just a moment, which is candidly a perfect segue for Chris and how we think about balance in portfolios, because it's not just about equities. Equities are fun. Equities can be like the interesting part of the portfolio, but we do need, as thoughtful investors, require diversification. And candidly, there's a lot of interesting things going in bonds today. So, Chris, I'll turn it over to you to pull up on what's going on in bond land.
Yeah, and I think that is a great segue. So, as much as we lean into equities to be the compounder and the growth engine of portfolios, we do have to recognize that times like this are not going to persist forever. So, how do we think about the appropriate balance within the allocations that we're building and what that looks like? Because there are opportunities elsewhere, as we're going to talk about next. So, thinking about the fixed income market and what happened in the quarter and the year, it was similar to what Brad was mentioning, albeit a slightly different path that we found ourselves on. When we were looking at the first portion of the year, call it through those first 4 months up through April, interest rates were generally coming down, in part because there was a bit of concern about what was happening in the Middle East and the impact that that was going to have on the economy and in corporate America. But very quickly, the conversation shifted to, well, all of a sudden, inflation is coming back. And as much as we had experienced that in 2022, many people, including the Federal Reserve and everyday Americans, did not want to go through that experience again. So as we saw inflation pressures begin to rise, that put a bit of a headwind and slowed down performance in fixed income markets. Now, as you look across the board here, what you'll notice is that municipal bonds did okay, particularly for things like high yield municipal bonds. So, as you're stepping out into satellite sectors of that market, and the same thing was true in the US high yield market, where bonds were up about 2% on a year to date basis. The area that has not done as well and is in fact negative now year to date is core bonds. So right there in the middle, that biggest allocation that so many investors, whether institutional or individual, have in their portfolios is that core bond allocation that's designed to be that safety component, that ballast and protection element. Has now flipped to negative year to date because we've seen the 10-year Treasury rise to 4.7% as of today. So what's the implication of that? Well, what we want to point out is that oftentimes where you're starting your portfolio in the fixed income markets is what's going to dictate your future and your go forward return and performance. So we're looking at each of the decades here, beginning in 1960 and stepping forward. The orange dots show what the starting point yield was at the beginning of the decade, and then the numbers within the bars are telling us what performance was throughout that 10-year period. What you'll notice is that bonds were positive in every single decade since 1960. Of course, that doesn't mean that purchasing power grew throughout that time because we've had very different inflationary environments. What I would point out, though, is a couple of things. One, when you're looking at the 1970s, it's a question that we receive a lot. Interest rates were going up. Well, that must have been bad for fixed income and bond markets, right? It turns out that wasn't quite the case because yields were higher and they had already risen. That provided you a cushion of income and protection within the fixed income allocations that you had. So that starting point yield was just under 8%, and over that 10-year period, bonds made about 7%. The higher yields went, the more fixed income investors were able to participate and benefit from the higher income and coupon. And that now brings us to today. So each of the decades we're looking at here stop at the end of the decade, and we don't see that experience post 2020. Well, since that time, interest rates have gone up a fair bit. And as I mentioned, that 10-year Treasury is now at 4.7%. A core bond portfolio is offering a yield to worst or distribution yield above or right around 5%. So that's an interesting opportunity as you're thinking about that starting point and going forward. Fixed income markets or equity markets have been great. There's been tremendous momentum. But when we're thinking about portfolios, you have to find that appropriate balance of risk taking and preservation within the portfolio. And that's a lot of what we're trying to emphasize right now. Now, thinking about the risk reward trade-off and what could potentially happen, we have a slight schematic here that I'll walk through and hopefully it comes across. But what would happen if interest rates rose further from here versus falling? And in the world of fixed income math, as interest rates go up, bonds tend to lose money, and as interest rates go down, that winds up being a positive tailwind. When you're looking across the graphic here, what you'll notice is that when we're in the mid 2000s going into 2021, the graphic looks like it's skewed to that lighter shade of blue, or at least to the downside, which was telling us at that point in time, if interest rates rose, you ran the risk of losing more money than the amount that you were going to make if interest rates fell, because they only had so much further that they could go down. What we see today is the cushion has gone up. There's more protection within the fixed income market, and that is allowing, even to the extent that interest rates rise, it's allowing for fixed income to do its job. Now, I say that with the caveat of fixed income markets are flat to down this year. We don't view that as indicative of the go forward experience. We still think that as inflation starts to settle down, and Brad's going to talk about what the geopolitical picture looks like and how that could happen. But as inflation starts to settle down, there are opportunities for fixed income to come back in favor, and that's where that opportunity now comes back. But as we're thinking about fixed income, it's not just about that core portion of your portfolio. So here's a number of different valuation matrices, if you will, starting with cash on the left-hand side, and then moving across each of those asset classes that we often think about for portfolios. What we're looking at here is the valuation rank today relative to the last 20 years on a yield basis, meaning where is the yield today relative to the past 20 years? And as you look at the first five columns on the left-hand side, every one of those tends to be near the top end of the range. That was as of the end of June, and the numbers have gone even a little bit higher given the backup in interest rates. What that's telling us is that the reason people have been allocating to fixed income right now is that there is more yield, there's more income, there's more opportunity on a go-forward basis. That's interesting in our opinion as you're thinking about that balance within your portfolio, and it is an opportunity. Now, I want to hand back to Brad, talk on the outlook, what the geopolitical picture looks like. We've been spending a lot of time on that the last 7 months. We would have thought that the geopolitical backdrop maybe got a little bit better or was starting to quiet down, but as you mentioned early on, that's not been the case.
No, it unfortunately has not. And so before we get into the state of affairs today, again, we're going to do our America 250 zoom out here and try to take just a step back and put in context the idea of conflict and where it sits in our portfolio. So, this, if you can't see the whole slide, all the way going back to 1926. This is U.S. large cap stocks over that time period. And it is not without fits and starts. It is not without recession. It is not without global conflict. But yet you can see by far and away, the line is up into the right. And so as we think about just the title of this slide, "This too shall pass," is somewhat an acknowledgement of no one, absolutely no one can predict exactly how geopolitical events occur, when they occur, what it means to the economy, and what it means to our portfolios in a very short period of time. What we are fairly confident of, though, is over time, right? That these tend to be less material to long-term allocations. And as we look back over major military-based conflicts and events, you really have to get into the arc of World War II or other multi-nation long-term events to see very material impacts on the global economy, very material impacts on long-term inflation. And so we're somewhat acknowledging the fact that we, nor does anyone else, perfectly know how and when all of this will resolve, but that over time, it ends up working best for those that are patient. Now, zooming way back in from 100 years of history and looking at where we stand today, one of the things about the conflict today that has made it less impactful is oil reserves. So we've talked on many calls in the past. How is oil priced? We know it's priced globally, right, on an incremental barrel. So even though an American consumer does not necessarily start up their car based on a barrel of oil that moved through the strait, it's still influencing prices at the gas pump. And why is that? Because it's priced incrementally globally. And we know that the strait, it ships many goods, a lot on the energy side. So why hasn't the economy, why hasn't inflation in a very meaningful way taken off, if you will, or the economy really contracted? Well, part of it is that around the globe, the US included, has strategic reserves. So here in the United States, it's Strategic Petroleum Reserve. It's millions and millions of barrels of oil that are stored across Gulf states and others here in the United States. And in periods of stress or need, we can draw from those to keep prices from rising that really hurt consumers and hurt the economy. Many other nations around the world have something similar. The United States happens to have one of the largest. But point being is as you draw from reserves, think about your bank account, right? If someone were to lose their job, hopefully you have rainy day funds, right? And you can draw from that until and pay your mortgage and groceries, etc., until a point in which you don't have any more rainy day funds. Well, this is the sovereign version of their oil rainy day funds. And countries can draw from these for a period of time, but eventually, they will run out. And so it's why Chris and I have been talking about this idea of a shot clock around needing to close out resolution. It's one of the reasons, albeit amongst many, of why the administration is so motivated to find a memorandum of understanding and open up the strait. The other, which we've noted on our previous calls, is really around political. Politically, I think there's a lot of motivation with the midterm elections coming up this fall that the sitting administration would like to close out the current conflict. Conflicts and higher gasoline prices and higher inflation are things that do not get people excited about voting for the current administration at the voting polls. Regardless of what you believe, red, blue, or purple, it does tend to tip the scales. And so there's a lot of motivation to seek resolution here, but unfortunately, we are in a cycle in which we have not currently found resolution. And candidly, we're in a current cycle of escalation. We've seen that in market volatility as of late. We recognize that it is here today, oil crossing 100. But as Chris pointed out before we joined the call, it's important to note that even though we see a little red on the screen today, that markets are kind of within spitting distance of all-time highs. I think we're 3% from the all-time high here on the S&P 500. So it is not as if markets have been falling precipitously, and that gets back to that idea around earnings and earnings growth, which has been so strong. Now, Chris, I know we have another slide in here around oil demand and supply, but I think it actually makes sense to jump to the economy and talk about really what's been, driving and been resilient in the economy. So why don't you pick up here and just talk about like how this is impacting the economy and then how that applies to the shot clock.
Yep. So the thing that has been relatively surprising over the last couple of quarters has been the economic strength that is not only there but also growing and gaining momentum. What we're showing on the screen is called the Citigroup Economic Surprise Index, and it tells us what was the expectation of an economic data point or release that came out, and what was the actual data on a relative basis. You can see here, as you're looking over the last 9 months, economic data has surprised to the upside, meaning more positively than expectations in every single week going back to last summer. This is one of the longest stretches we've seen since the COVID reopening environment, in which there were a lot of fiscal stimulus dollars supporting the economy and supporting spending. And so the question becomes, why is that happening? Well, the forgotten fact and the reason that that's happening is because tariff policy started to really back off when we go into October of last year. So there was an escalation that was happening throughout March, April, May, and June of 2025. We started to see some leveling off of the rhetoric that was going back and forth between the US and other countries. But at that point, the effective tariff rate was quite high. And what we began to see is that agreements were getting negotiated from the US and certain parties in particular. But then also we began to see that the court system intervened. And there was a Supreme Court ruling that took place in the first quarter of this year, which effectively overturned a number of tariff policies, not all of them. But as we saw in October of last year, the effective tariff rate began to move down pretty quickly. And that was a moment in time where companies could begin to say, all right, we're comfortable spending more money. Americans could look around and say prices aren't necessarily going up as quickly as they were previously from tariffs being implemented on goods. And spending came back, and spending begat more spending. It begot labor market strength. It also fed into corporate strength and companies basically saying, all right, 2026 is here. We're ready to go. That's been a large part of the story that we've seen. The other part has been what you were describing earlier, Brad, the spending that's occurring in the AI and the artificial intelligence segment and CapEx, how that's really flowing through and coming down to the rest of the economy. We are seeing that beneficiaries are moving out of the top end and out of the biggest companies in the US to small mid-cap companies, as you mentioned, and that's leading to better performance there, which has been a welcome development. The other element of this, though, which I think is important to share with everyone, is that as you go back to last year, the commonly held belief was that artificial intelligence was going to displace a lot of people from jobs and opportunities. And if not displace them from jobs, it was going to limit the amount of hiring that took place. We're so far this year not seeing that as the case. And we saw even just this morning that initial claims for jobless benefits fell below 200,000, which is remarkably low when you're thinking about a labor force that is measured to the order of 150 million. So very few people are filing for initial jobless claims and benefits. One of the reasons that's happening is because more individuals are stepping into retirement, which is opening up job opportunities for others that may not have been there previously. So the economy has really powered forward and done quite well. But now we have to talk about that role of the Federal Reserve and what is the Fed going to do? There's been a lot of fiscal spending that's happening with the larger deficits coming out of Washington. Now we see on the monetary policy side, there's a new Fed governor that stepped into the role and perhaps not going to take the same tactic as his predecessor. So, Brad, where do you think Fed and interest rate policy goes on a forward-looking basis?
Oh man.
And we want an exact prediction. It's got to be to the decimal point.
Chairman Warsh has work cut out for him. It's a tough time in two ways. One, where we sit in the economic cycle is tricky, right? We have this exogenous effect, one which is coming from AI. We don't quite know, as Chris you mentioned, the predominant view is it's going to be deflationary, that it's going to create job losses or lack of job growth. We haven't seen that, but that was the economic viewpoint. Then we have this exogenous effect too, which is military conflict and headline inflation pressure, which creates the opposite side of the narrative. And the Fed is really responsible for price stability and full employment. And the balance of those two is an interesting seesaw from which to navigate. Now, that is, if any chairman or established chair were sitting in that economic environment, it's a tough road to hoe. I think we all need to recognize the Fed does not have inside and perfect information or a crystal ball. They are taking the same information that we have and they are trying to distill it and do something thoughtful with it when setting banking policy and interest rates. Now, you add on top of that the dynamics within the Fed. It's important to remember the FOMC is a board, not a dictatorship. The chairman is important. So Kevin Warsh is responsible for seeking consensus on the board. We have seen the recent Fed minutes. There is not consensus. And by the way, we don't view that as a nefarious thing. If we had true consensus from a diverse board in the economic environment, which I just described, there would probably be some hubris there in thinking you know exactly how all of this is going to unfold when in candid, we don't, and the Fed does not either. So the chair is sitting here seeking consensus from the board, wanting to lower interest rates, but not having an environment that labor is really dictating it, right? That they need to come to the defense of labor, that job losses or unemployment is rising. That's not currently the prevailing thought. On the flip side, obviously, we have geopolitical risks sustaining, and that is putting upward pressure on inflation. If anything, that tilts more towards the potential for raising rates. What we likely think happens here is you have a higher for longer period. And by the way, that is quite reasonable in today's market environment. Long term, the Fed is trying to seek to get to neutral. Neutral is about 2% or the target inflation or current inflation plus 1% real. So if we had 2% inflation, the Fed funds rate should be about 3. Obviously, inflation is not at 2% today, and we're not too far off of real. So it is something that we'll continue to watch. Obviously, the Fed chair is in a pretty tricky spot, navigating both the board and these dualities of exogenous events, plus a really, really robust earnings environment and growth. We think it's likely that they'll probably be sideways for a little while longer here, but we know in the coming months, and especially September, which is a more meaningful meeting after people come back from the beach and actually get their hands dirty again in markets and the economy. That tends to be a highly watched meeting as well. But we think it's likely that we'll be in this, kind of sideways for longer and wait to see where it lands. So, Chris, why don't you take us home here? I know we've been bouncing in and out of how we think about long term America 250, what's really driving long-term corporate profits, what's really driving investor outcomes, and today the interesting economic cycle of innovation and AI and how it applies. So I'm curious, how are you going to put a bow on all of this?
On 250 years of history, I'm not sure I know either. What I would say is that there are a lot of lessons learned over the years, and I think part of what we wanted to walk through and discuss today was all of those, not necessarily all of those lessons, but a number of really important ones and how they can apply in current economic and market environments, and how people can think about them to ground your portfolio and investment approach and align that with your goals. Ultimately, when we're thinking about the US experience, though, we do have to recognize it may not be a perfect one, but it has been one that's been remarkably stable, despite what many of us might think from social media and headlines in the newspapers and elsewhere. The United States has had one single continuous constitutional system over that time frame. When you're looking at countries like France and Germany and China, you can see the number of different government forms of government, whether republics or primary forms of government that were different and distinct from the regional ones. So why is that the case? Well, there have been a lot of systems built over time. You're talking about the Federal Reserve and the handoff to Kevin Warsh. That process has gone relatively well in these past few months, despite a lot of headlines that were quite negative on the process and how it was going. And yes, there are always going to be questions around the institutions in the country, but as you're thinking about the Federal Reserve, you're thinking about the U.S. Treasury Department, you're looking at the rule of property rights and the rule of law that exists in the country. There has been a remarkable level of stability that we've benefited from, which has attracted capital. So at the end of the day, we're here to talk about the investment market landscape. Because of the systems that were there, it attracted capital to the U.S. markets. It's attracted the biggest companies to the U.S. market, and that has been a really strong reason that over not just recent years, but in recent decades and recent centuries, the U.S. stock market has done so well. Now, as we think about the market and economic events and then what we need to pay attention to over the next few quarters, Earnings are providing us a lot of cover for all of the blemishes that may be happening out there. We are intentionally ignoring things like rising credit card debt and lower affordability, particularly as it comes to the housing market. Well, earnings at the corporate level are really covering those blemishes, but you can't ignore things like affordability forever. That's why there was a housing bill passed over the last couple of weeks. Especially as we get into the midterm elections, there is going to be a lot of question and conversation around affordability. Markets are certainly priced right now for a pretty benign environment on a go-forward basis. So what you need to watch out for and what we're seeing in these last couple of days is where are the expectations relative to the reality, and have they simply moved too high, either on the economic front or at the individual stock level? There is a balance to be had here where it feels like that rosy picture is not going to last forever. So think about your fixed income allocations or diversifying allocations within portfolios. It is a good time to make that trade-off and consider it in your personal context. I will say on the international side, Brad was mentioning the idea of the shot clock is running. We only have so much more time and resources that we can continue to extract from that strategic petroleum reserve. It is not going to persist forever, as we can all understand. And the shot clock is most certainly running. There is a motivation to try and find an agreement. Whether that happens or not is the big outstanding question that nobody can answer. So Brad, with that, we'll go ahead and wrap up. We'll see if there's any questions or if people want us to expand on any of the topics we went through.
I pulled through the Q&A. I think we got to most of it. I don't see any that, weren't sitting out there. Maybe Chris, just kind of, my final question to you in reading through the thread of some of the other questions, as you mentioned, hey, it's a good time to be thoughtful, a good time to be balanced, consider fixed income. I know we're not market timers. We're never going to say, hey, jump out of equities and into fixed income or vice versa, but building that, kind of diversified and thoughtful portfolio. So in today's, rosy environment where we see a little volatility, what are those handful of things that you would say, just good housekeeping reminders for investors that as they round out the summer here, to not forget and to fall and lull into the, common traps that people fall into?
Well, I think one of the ones is that you were just pointing out there is we are coming to the end of summer, and August, September are notoriously much more volatile in the equity markets. Why is that? Well, not as many people are around and trading in the month of August, and then all of a sudden everybody comes back in September and says, "Oh my gosh, what have we been ignoring for the last 3 months that we need to start paying attention to?" That's not to suggest that you should engage in any sort of short-term market timing, because that involves frictions of transaction costs and taxes and fees and all sorts of other issues. So what we guide to is think about the marginal and incremental changes that you can make in portfolios that allow you to slowly and incrementally move towards your goal. What we see from all the research that's out there and the research that we've done is that small incremental changes are a lot more beneficial over time. Things like rebalancing, harvesting tax losses where you can, to allow you to facilitate rebalancing without experiencing higher taxation. Doing the small things on an everyday basis is a lot more powerful than making a single point in time change. And so that's what we've always encouraged. Don't forget about those behavioral aspects. Do it slowly, do it incrementally. Don't do it all at once. Did I miss
Very
any,
cool.
Brad?
No, fair and wise, and I think to the point. Well, look, we appreciate everyone carving out an hour for us in the summer. We will be back this fall. So, two things I will mention as we start to pitch towards the fall. One, you're going to see a fun new launch from us coming in September. We're launching our new website. You'll see that reflected in some of the colors in marketing here, which will be a new and interesting opportunity for us to showcase some of the fun stuff coming down the pike. And then as we get towards year end, we'll be excited to start to incrementally talk about our 2027 outlook. Where do we go from here? Portfolio positioning. Obviously, we'll be moving in that direction in earnest as we approach the end of the year. So until then, have a great rest of the summer. We look forward to seeing you this fall. And thanks for joining us. We appreciate it.